Hi, I'm Cole Pearson, President of Investment Solutions at OneAscent. I want to share a headline that I came across recently that if you're invested in the stock markets or public markets in general, I bet you're likely aware of and certainly experiencing for yourself. The S&P 500 is headed for the worst start to a year since 1970. And for tech, it's the worst in history. Wow, that's a bold and a serious statement. But as with anything, it's important that we take a closer look at the numbers and put them into perspective. From the start of the year through May 24th, which is the date that MarketWatch initially published that headline, the S&P 500 is down negative 17%. But let's add some perspective. How does that number compare historically? This chart shows the S&P 500 over the last 40 years through the end of April. The gray bars show the full year returns for each calendar year. The red dots show us the intra-year declines within each calendar year. In essence, the largest market drop from peak to trough at any point during the year. So what does this tell us? Over the past 40 years, the S&P 500 has experienced an average intra-year decline of negative 14%. Yet, it's still finished in positive territory in 31 of those 40 years. In fact, the average calendar year return during the same 40-year span was a positive 11%. To be sure, consistently predicting when stock market declines or rallies will happen or how long they're going to last is an impossible task. Probably much like you, no one looks forward to market volatility. But intra-year declines are normal. While market declines are common, they're also temporary. And of course, we find ourselves in one of those periods today as we've started 2022. So, I want to share quickly with you our outlook, what we're doing about it in portfolios, and our thoughts on what investors should and shouldn't do in periods like these. During our most recent quarterly market update webinar, we discussed the fact that accelerating inflation combined with high valuations led stocks to sell off in the first quarter. It's sort of like birthday cake. A little bit of inflation is just fine. But just like too much cake leaves your stomach feeling ill, too much inflation has left the market feeling queasy. We've been talking for some time about how the market has been expensive, but that doesn't usually affect or matter too much in the short term. The prices we pay today typically affect returns over the next few years, not the next few weeks. As we entered 2022, we were expecting the economy and corporate profits to grow, albeit at a lower rate of growth coming out of 2021. That view is still intact. What's changed has been the market's expectations and fears around inflation, followed by the concerns about the Fed putting us into a recession as they raise rates to combat that inflation, and then it's been capped off with Russia invading Ukraine. What that led to was allocations to higher priced and growth-oriented stocks to underperform. Here's what we're doing about that in the portfolio. An important point I want to make is that we have not made changes to our manager lineup within the equity portfolio. What we have done is make some minor tactical adjustments. Our underlying managers are also repositioning their portions of the portfolio to take advantage of opportunities in their markets. In the fixed income portion or the bond portions of our portfolios, we have made some adjustments. We've shifted the portfolio to shorter term bonds to be less exposed to interest rate risk and more exposed to corporate bonds. Another exciting change so far this year is that we're excited to announce a new strategic partnership with Nuveen, a TIAA company. They now manage the bulk of the fixed income exposure in our strategies. And what we've done is we've combined OneAscent's values-based investing approach with Nuveen's decades of experience and expertise into a strategy that focuses on making a positive impact in both direct and measurable ways. So lastly, a few ideas about what to do and what to avoid. Number one, avoiding mistakes is the key to winning long-term with your investment portfolio. We urge investors to maintain discipline to their plan, which allows the greatest chance for success. We often show this chart, which highlights that the average investor significantly underperforms most of the common asset classes for two reasons. Number one, behavioral biases they may have, but number two, it's emotional reactions to short-term market swings. We encourage investors to resist making drastic allocation changes. Stick to your plan and maintain an allocation that's appropriate for your long-term financial goals. Just as we believe that baking a cake is best done with friends, we believe investing is best done with your advisor. Staying in communication with your advisor about your questions, your concerns, and how those affect your future financial goals can help to improve your outcomes and make you a better investor. At OneAscent, we're here to serve you. If you haven't already, please check out our website for more timely market insights and weekly investment commentary. Thank you for watching and have a blessed day.